Okay, let's just jump right in. The crypto market got absolutely hammered this weekend. We're talking a digital bloodbath that wiped out billions. So, what in the world just happened? We're going to break it all down.
This is absolutely insane. I mean, that's pretty much what everyone was saying on social media, right? People watched billions of dollars just, poof, vanish overnight. A total shock to the system for a lot of folks.
And the shock was real. $800 billion. Just think about that number for a second. That's how much value was erased from Bitcoin alone since its recent peak. It's a figure so huge, it's honestly hard to even comprehend.
And the craziest part? This all went down on a quiet weekend, which caught almost everybody completely off guard. So, what was it? What actually caused this thing to collapse? Was it just a panic sell-off, or are there some deeper forces at play here? Let's dig in and see what this whole mess tells us about the state of crypto today.
All right, first things first, let's get a handle on just how bad the damage was this weekend. And I'm not talking about a minor dip here. This was a full-on, straight-down plunge.
Yeah, the sell-off was just brutal, and it was everywhere. Bitcoin dropped all the way to around $77,000, hitting price levels we haven't seen in more than a year. The fall was so bad, it actually knocked Bitcoin out of that prestigious top 10 global assets club. And look at that last number, nearly 200,000 traders, 200,000 individual accounts just completely liquidated, wiped out.
So you have to be asking, what on earth could cause something like this? Well, it wasn't just one thing. It was this perfect storm of factors. One analyst even called it a three-headed monster that just slammed into the market all at once. You had these three different pressures hitting the market at the exact same time, creating that perfect storm. We're talking geopolitical shocks, a massive hard money reset, and then, the widespread fear that just feeds on itself.
So, the first trigger? It was literally a spark from the other side of the world. Reports of escalating military tensions between the US and Iran. Now, when things like that happen, what do investors want? They want cash, cold hard US dollars. And because the crypto market is open 24/7, Bitcoin basically turned into the world's ATM. It wasn't acting as a safe haven, it was a source of emergency cash.
And this wasn't just a crypto thing. Not at all. Just look at what happened to the traditional safe assets. Gold, it took a pretty big hit. And silver got crushed with a historic 26% crash. That tells you right there that something much bigger was going on in the global markets.
So, what was the culprit? A surging US dollar. The dollar got super strong really fast, and when that happens, anything priced in dollars, like gold, silver, and Bitcoin, suddenly becomes way more expensive for anyone outside the US to buy. That set off this huge wave of selling, this de-risking, across all of those so-called hard assets.
Okay, so those were the external shocks. But now let's look at the internal mechanics, because this is how those outside sparks lit an absolute fuse inside the crypto market itself, and this is where things got really explosive.
So how did the price fall so fast? To get that, we have to talk about something pretty unique to crypto trading called a liquidation trap, and it all boils down to one word: leverage.
So what is leverage? Well, in simple terms, it's like betting with borrowed money. It lets traders make these massive bets without putting up a lot of their own cash. It's a classic double-edged sword, though. It can amplify your profits like crazy, but it can also amplify your losses just as fast.
And this is where you get this incredibly dangerous domino effect. That first price drop from the external shock, it starts triggering automatic sell-offs for anyone with these leveraged positions. But that forced selling pushes the price down even more, which, you guessed it, triggers even more liquidations. It's just this vicious downward spiral that creates what traders call air pockets, where the price just completely collapses because there are no buyers.
And the scale of this was just mind-boggling. In a single 24-hour period, a staggering $2.5 billion worth of these leveraged positions were just gone, forcibly liquidated, and the vast majority of those were from traders who were betting the price would go up.
But here's where the story gets really interesting. While all of this chaos and panic selling was going on, the on-chain data, the data from the blockchain itself, tells a completely different story. See, not everyone was running for the hills. Okay, so if you look at the wallet data, you see this huge split. You have the small fish, the regular retail folks with less than 10 Bitcoin. They've been selling in a panic for over a month now. They're capitulating. But then you have the mega whales, the biggest players in the game, holding over 1,000 Bitcoin. And what are they doing? They're quietly buying. They are literally absorbing all the coins being dumped by the panicked smaller traders.
So what are we supposed to make of all this? What's the big picture here? Look, we've seen these kinds of speculative bubbles pop before. The real question is this just a healthy reset, or is this the start of another long, painful crypto winter?
It's really fascinating if you compare this crash to the last big one back in 2022. You see a pattern emerge. Yeah, the names have changed, the companies are different, but the underlying human behavior, the crazy speculation, the unwinding of super risky bets, it all looks eerily similar. But you have to remember, there is one absolutely crucial difference this time around. The market is just way more mature. I mean, you now have massive Wall Street institutions like BlackRock and JP Morgan deeply involved in the space. That institutional foundation just flat out didn't exist in the last crash.
Still, let's play devil's advocate for a second. What if history were to rhyme? What if all the speculative froth and excess needs to be completely wiped out, just like it was back in 2022, when Bitcoin fell 80% from its peak? If that happens, well, the potential downside is pretty severe.
$25,000. Yeah, that's the number. It's a scary thought, no doubt about it. But it kind of highlights what might be necessary to completely flush out all the leverage and, frankly, the grift from this last bull run, to really prepare the market for the next sustainable move up.
And it really feels like that's where we are. The tide may not be fully out yet, but you can feel it heading that way. And that brings us to a classic piece of wisdom from one of the world's most famous investors that just perfectly captures this moment of truth for the entire crypto market.
It's only when the tide goes out that you discover who's been swimming naked. I mean, that's it, right? This crash is pulling back the water. It's revealing all the fragile, over-leveraged parts of the system. And it leaves all of us wondering who and what is going to be left standing when that tide fully recedes.